Hi everyone.
Alan, we can start. Alan, you wanna give the opening remarks?
Feel free to do.
Please go ahead. Yeah.
Okay, so let's start our first session on ESG. Here we have the pleasure to have Pedro Matos as the mediator of this session. We will have also Lubos Pastor and Lauren Cohen speaking about their research on the effects on adoption of ESG in financial institutions, this investment decision, and other interesting topics related. So I'd like to take the opportunity to thank all of you for the time for being here with us. It's a pleasure to have. We would like to have another opportunity you here in person to enjoy the possibility of having drinks and Brazilian music after the session. So without further ado, please, Pedro, the floor is yours. Thank you very much.
Thank you, obrigado, Alan. So I'll start with a few words in Portuguese, and despite my accent not being from Brazil, I want to boas-vindas a todos. Prazer moderar painel fantástico. Hoje começamos com o Lubos Pastor e o Lauren Cohen. Vou partilhar aqui a minha so today we're starting with the panel with Lubos Pastor and Lauren Cohen, and tomorrow morning Brasilia time and also US time we'll have a second panel with Laura Starks and Aaron Yoon. I'd be much happier to be in Brazil. This is literally pictures for Lubos and for Lauren from my phone. One of the most beautiful islands in the world, which is Fernando de Noronha, off the coast of Brazil. And that's just a regular day in Ipanema at the end of the day. So this is, a big shout out to everyone that's joining us from Brazil, given the tough situation over there. I want to, wish all the best I did join before to this Brazilian finance seminar and acknowledge Rui and Alan's effort to put together. I did talk about a CFA report that I wrote on ESG, and I just wanted to highlight for people who are not initiated with ESG, perhaps a few things, and then we'll move on to the presentations. So it's available online, and I will put that on the chat later. But basically, ESG, think about environmental as everything that's not currently reflected in traditional accounting. So environmental dimension, impact of a firm like carbon emissions, pollution, etc. So in Brazil, think about like the Amazon deforestation or climate change just broadly. If you think about social dimension, you think about the workforce, communities, and customers. And in the case of Brazil, we had the Vale dam collapse, with several workers, but also communities were affected as a result. And if you think about governance, Brazil might be pretty central to that. If you think about car wash, the political scandal that spilled over from the government to the many companies like Petrobras, etc. And beyond this high-profile scandals, you have this drive by major investors around the world. The big three are represented there, but also by major corporations talking about ESG these days. And this is the statement of the purpose of the corporation by the Business Roundtable. It's very controversial because, it's pushing other interests and generating shareholder value last, perhaps. And so that's been a sort of tension to what we currently see. So I would say the biggest driver in the conversation is climate change. So both of the papers today will talk about them. The fact that we now have human-made or greenhouse gas emissions, and how that is being addressed in different places in the world, if that's going to create physical risks or transition risks, but also regulatory changes, right? Regulatory changes in the form of like the European Green Deal, or in the US, there's still open debate on that. In my survey, I've focused more on institutional investors. That's something we'll talk more tomorrow. And Laura has a paper about that tomorrow, so I'll defer that about the growth and the role that different investors might play. But and then tomorrow again, we'll talk about a little bit the debate about which Lubos and others have also contributed to, about the theory behind whether investors should earn a compensation, so do well by doing good, or investors should be rewarded to hold sin stocks, something that will come up in Lubos' discussion. So sort of the do good by doing well discussion that's very, very much alive. I have some work which I'll skip on, the spreading of responsible investing around the world. But what we're left after some of that work, which I've presented to this Brazil forum before, is there's been very many open questions. One, how do we measure ESG? There's a lot of dispersion across the ratings. There's a ton of discussion about going beyond equities. A lot of the research tends to be focused on equities, and Lubos, for example, will talk a little bit about green bonds as well today, other asset classes, and fundamentally whether we're achieving any of the goals. So if you think about ESG as achieving those sustainable development goals I had in the onset, whether this is really any capital solution, not a government solution, but a capital market solution can spur change in the direction of addressing those challenges. So even today, if I open my Financial Times, I do receive this on and on. So this is the wave of capital that's flowing towards ESG strategies. This is by generation, one of the Al Gore affiliated firm, and the carbon emissions were affected by COVID. You have a slight dip there in 2020, but nowhere close to where we need to go to avert climate change. So this is, every day you'll hear about this. So very pleased to welcome Lubos and Lauren. We'll go in this order. And what I mentioned before, this discussion about what should investors expect to earn, not just in terms of the ex ante returns, but the ex post returns, and the confusion that exists between those two. So that's dissecting the sort of the green returns investors might be. And then Lauren is going to talk to us about, well, if capital is flowing towards and rewarding ESG, is it going to the right place in terms of actually unlocking the technological solutions to address the climate change problem, and he's going to dive into the oil sector and energy sector broadly, whether those are sometimes actually producing more green patterns than you would expect. So if investors exclude them, then they might be doing a disservice to address the problem. So that's it on my side. And I really looking forward to the first presentation by Lubos, and we'll break for 5 minutes. Let's use also the chat if you have questions, and then we'll then ask those questions to Lubos, and then go for Lauren for another half an hour, and finally open up for a broader discussion after that. So thank you, Lubos. The floor is yours.
Thank you very much, Pedro, for the invitation as well as for the floor. And thank you, Rui, as well. It's a pleasure to be here. The paper I'm going to present is brand new. So this is joint work with Rob Stambo and Luke Taylor. And it's the very first presentation of this paper. So I just finished the slides today. We'll see how it goes. The motivation is very simple. If you look at large firms like BlackRock, State Street, and others, they are marketing ESG pretty heavily. They clearly like the fees on these products. And while promoting these products, they like to say that these products have performed well in the past. So I have a couple of quotes for you here from BlackRock and State Street suggesting that ESG products have had strong returns. And indeed, there's also some academic evidence pointing to strong performance of ESG products in the past. In this paper, we ask, what does this past performance mean for future performance? Okay. And the key idea, the main point that we're making, it's a very simple point, is that realized returns are not the same as expected returns. And even though past returns have been strong, they are not a guarantee of future returns being similarly strong. In fact, I'm going to argue that realized returns we've seen in the past are higher than the expected returns going forward. And I'd like to begin with an example. And it's an example of German green bonds. So Germany, the largest European economy, is in a special situation because starting last September, less than a year ago, they began issuing green government bonds. So these are bonds whose proceeds are meant to finance a transition towards sort of a sustainable economy in Germany. And they've issued about $8 billion worth of these bonds. What's interesting is that this is a particularly clean case if you want to look at sort of how much investors are willing to pay for being green, because each green bond has a conventional twin by design, and that twin is not green. So there's like a conventional bond, and then there's a green bond with the same maturity date, same coupon rate, same coupon payment dates. Everything is kept the same as much as they can, just one is green and one is not. So we can look at the expected returns and the realized returns on these two bonds. So what I'm plotting here for you is the time series, the history of the yields to maturity on both the green bond, plotted in green, and the conventional bond, plotted in kind of the dashed blue. The first thing you'll notice is that both yields are below zero, which is not surprising in Europe. As many of you know, interest rates are negative at the moment. So that's not what I want to talk about. The first thing to notice is that the green line is always below the blue line. So the green bond yields are always lower than conventional bond yields. In other words, there is a premium for green. Investors are willing to pay more, in other words, accept a lower yield, a lower expected return for holding green securities. So in the next figure, I'm going to plot the difference between these two lines. Okay, the difference, which is sometimes called the green premium or the green yield. I'm plotting it at the top. This is the difference between the yield on the green bond minus the yield on the conventional bond. And you see that when the 10-year bond was first issued, the green yield was on the order of 2 basis points per year. In other words, investors were willing to accept a lower expected return, assuming they buy and hold to maturity, of 2 basis points. But then what happened over time is that the green yield actually widened from 2 to about 5 basis points. As a result, if you're an investor and you went long green bonds and short conventional bonds, you ended up making money. Okay, you ended up earning a positive cumulative return. That's what I'm plotting here. And this return is actually statistically significant. So basically, a green investor has made money over this 7-month period through April 2021 by going long green and short the conventional bond. But does that mean that we should expect higher returns on green bonds going forward? Clearly not, because when you think about what's happened is that at the beginning in September 2020, green investors were willing to accept a yield 2 basis points lower than before. Now they're willing to accept 5 basis points less. So going forward, actually, the expected return is even lower than before. So actually, this outperformance we have seen over the 7-month period is at the expense of future performance. It's like borrowing from the future. Okay? So this is a bond example. I think it's clean, but it's just an illustration. What we focus on in the paper is doing this for US stocks. So what we do is construct what we call a green factor for US stocks. And we are motivated by theory, which I'm going to describe shortly. This factor is not arbitrary. It ends up being long green stocks and short brown stocks, which is pretty traditional, pretty popular in finance, like the Fama-French type of factor. However, the weights are not arbitrary. The weights are derived theoretically. And then we document a few results about this green factor. So first of all, the green factor has performed very well. Green factor has delivered a cumulative return of about 35%. and it's positive and statistically significant. So green has outperformed brown over the past decade. Does that mean expected return going forward is higher for green assets? Not necessarily. In fact, we show that the outperformance of the green factor has been due to unanticipated increases in climate concerns. In other words, the factor's realized return has been greater than expected return. There was a positive surprise, positive element of surprise embedded in the realized return of the green factor. And that's sort of the main result. This third bullet is our main result. We also show that the outperformance of the green factor can help us understand the unprecedented underperformance of the value factor in the previous decade. So as most of you will know, value stocks have underperformed growth stocks over the past decade. And this is unlike any other decade in recent memory. We argue this is because value stocks tend to be brown. In other words, they tend to have negative externalities for the environment. Growth stocks tend to be green. And when you control for the green factor, the underperformance of the value factor goes away or becomes insignificant. And then last, we have a curious result where we find that the green factor responds to news about climate concerns, but it does so with a delay of a few weeks. So that's the summary. That's our paper in a nutshell. Let me begin with the theoretical background that we use for this paper, and we are building on an earlier paper of ours, which is forthcoming in the Journal of Financial Economics. The earlier paper is completely theoretical. The paper I'm presenting today is completely empirical. In our theoretical paper, we have a very simple model which you're looking at. Okay, this is the model. So there's a range of firms that differ in their sustainability. They range from green to brown, and there's a range of investors because investors vary in how much they care about sustainability or about social responsibility. So some investors don't care at all. Their degree to which they care is 0, and other investors care a lot. And then what we assume is that investors who care a lot derive positive utility from holding shares of green firms and negative utility from holding shares of brown firms, whereas investors who don't care at all, well, they don't care. So then we just add some very straightforward assumptions and we derive the following implications. I'm just listing the key implications that I need for the current paper. Our first implication is that greener assets, stocks or bonds, have lower expected returns as well as lower CAPM alphas. And there are two reasons for this. One that is obvious from what I described already is that agents have green tastes. Agents derive utility from holding green assets, so they're willing to pay more for green assets. So holding the cash flows constant, if you're willing to pay more for the same stream of cash flows, you have to be willing to accept a lower return going forward. There's a second part of the paper where we also show that greener assets are better hedges against climate risk, and that's another reason why investors are willing to accept lower returns on greener assets. However, we also argue that greener assets can have higher realized returns during sort of transitional periods during which investors' tastes are shifting towards green assets and or green products. So for example, if customers' tastes are shifting from fossil fuel driven cars to maybe cleaner cars, and this is and they're shifting faster than expected, then you will see green firms outperforming brown firms. Okay? Or if pension funds pile into green assets faster than was expected, again, you'll see higher returns on greener firms. And then the last thing I'm going to talk about regarding our first paper is that we derive this, what we call ESG factor, which captures these shifts in tastes. Specifically, this factor is long green assets, short brown assets, and the weights are essentially their ESG score. So the greener the firm is, the larger the weight of that firm in the factor. We derive the expected return on the ESG factor, and it turns out to be negative. So the expected return on the ESG factor is, well, equal to minus D bar over A, where A is risk aversion. What is D bar? D bar is the average taste for green assets. So going back to my picture, D is the degree to which investors care. So if you average all those Ds, weighted by how much, but by the wealth of each agent, you get D bar. So D bar is like somewhere over there. The higher the D bar is, the more people care. And the more they care, the lower the expected return on the green factor. Okay? And we also show that that ESG factor, which we just derived, along with the market, prices assets in a two-factor model. So there's an exact two-factor model with the market factor and the ESG factor, and together they price all assets. So in this paper, we just focus on the green factor. We just focus on the E in ESG. Okay, we believe that E is the cleanest part of ESG. Okay, S and G, you and I may disagree about what's S, what social justice is, which firms are well governed. I think there's more room for disagreement there, but we all kind of want a greener planet, and even there, it's not quite clear, what's nuclear, is it green or not? But at least, there's more likely agreement is more likely to be found there. Okay, so now what do we do in this paper? It's all empirical. So we start with MSCI's ESG ratings, which we purchased from MSCI. Why did we buy data when there was data available for free? Because it's our understanding that this is the gold standard in empirical research. That they have MSCI has like 200 analysts trying to establish these ESG ratings. So we hope we have good data. And then we take two scores from MSCI. We take the so-called E score, the environmental pillar score, which is on the range of 0 to 10. So 10 is better than 0. And then we take the E weight, which is really the property of the industry in which the firm operates. Okay, so, and that's on the range of 0 to 100. So think of E weight is telling you how green the industry is, and then E score is telling you how green the company is within its industry. Okay, we don't want industry adjusted scores, so we combine them. And in particular, we construct our measure of greenness as follows. We take 10 minus E score, so that's like how close is the firm to the ideal score of 10 within its industry, and then we multiply it by how green the industry is. Okay? And then we put a minus sign in front of it so that it's greenness and not brownness. So overall, larger values of G indicate a greener firm. Here's an example of how important it is to adjust for the industry. If you take ExxonMobil and Best Buy, they both have an E score of, there is about the same, 4.1, 4.2 in the MSCI database. I think most people would agree that Best Buy is a cleaner firm than ExxonMobil. It's in a cleaner industry, like retail versus energy. And indeed, the weight of the industry makes it very clear. So our score of our greenness score assigned, it points to ExxonMobil being less green than Best Buy. And then we subtract the weighted average of these G's to get kind of a market adjusted G. And these are the G's we work with. So if you want, you can think of these G's as our ESG scores that we use in this paper. Just to show you that what we're getting is not crazy, here we are ranking all industries in the MSCI database by how green they are according to our measure. And what you'll notice is, especially at the bottom, it's pretty clear that, I was glad to see companies that I think most of us would tend to think of, or industries that most of us would tend to think of as less green compared to those you see at the top: chemicals, oil and gas, steel, metals, paper, forest products, etc. Now, here's an interesting property of the MSCI database. Until October 2012, MSCI only covered large firms. So there were a little more than 500 firms in the MSCI database. Starting October 2012, they expanded to cover many small stocks as well. And we decided we like the fourfold increase in the data set. So we are working with a relatively short sample, but it's a sample for which we have very good coverage starting November 2012 and going all the way through the end of last year. So that's the key sample period that I'm going to show you the results for. And frankly, there wasn't all that much ESG in the US prior to the financial crisis. And then even right after the financial crisis of 2008, I think most people just talked about the financial crisis. So the way I see it is that ESG really is a thing of the past decade. So I think we are capturing, most of it. Now, how do we actually construct the green factor? Starting with the theory. Our theory paper derives this two-factor model I mentioned earlier, in which the returns, excess returns on a set of assets, so think of this as a vector, is determined by market beta times the market return, plus the ESG beta times the ESG factor. realization, okay? And then there's an error term. It turns out, what's very interesting is that in our two-factor model, the betas, the ESG betas, are simply the ESG characteristics. So each firm's ESG score is at the same time its beta with respect to the ESG factor. So that's kind of neat. And it also helps us estimate this factor, because if you want to construct FG, the ESG factor, there's a recipe that follows from this equation. Specifically, move this term to the left-hand side so that you have market-adjusted returns on the left, and then run a cross-sectional regression of these market-adjusted returns on G. Okay, so we're running cross-sectional regressions of market-adjusted stock returns, individual stock returns on ESG scores, and then we take the slope from that regression, and that's our estimate of the ESG factor, which, you know, in our case, the green factor. And when you think about what that is, if you stare at this expression a little bit, you see that this really is a long-short portfolio where you end up going long green stocks and short brown stocks, and the weights are Gs. So they're not market capitalization weights, but ESG scores. So this is the series we construct for the United States. And here's the performance of that series. So here's the factor. It's a long-short portfolio. So you would expect the line to be roughly flat. It's not flat. The cumulative return on that factor is quite positive. And you see it's about 35% through the sample period. And it's statistically significant, as I'll show you on the next page. So this is kind of result number one. You see the ESG factor, long green, short brown, has done very well over the past decade. How well? Well, 31 basis points per month on average, with a t-statistic of 2.9. Okay. Here, each column, you're looking at 6 columns. Each column is a separate regression, where on the left-hand side, I have the green factor return, and on the right-hand side, I have these regressors. So in the first column, there are no regressors, which is why this is the average return on the green factor. If I control for the market, I get an even stronger result. If I control for Fama French factors, momentum, liquidity, etc., you see that the performance of the green factor remains positive and significant. Okay? You also see one other thing, a couple of other things. Greener firms tend to be larger. I think we've known that. And greener firms tend to be growth firms. This is a very significant negative loading on HML. So think of greener firms as being large growth firms mostly. There's also a positive loading on momentum and a mild negative loading on the investment factor of Fama French. You can also flip things around. Instead of having the green factor on the left and all of these traditional factors on the right, you can put something else on the left and put the green factor on the right. So that's what we do here. We add the green factor to the market. We use the two-factor model from our theory paper to see if we can learn something about the value effect. Because I don't know about you, but to me, one of the most amazing things over the past decade is that the value factor has performed so poorly, right? Traditionally, value has outperformed growth, but not in the past decade. And you can see that here. If you take Fama French's HML, that's what value is. Fama French's HML has had a negative CAPM beta of minus 71 basis points per month. It's not quite statistically significant, but marginally so. Okay, so value has underperformed growth over the past decade. However, when you add the green factor to the right-hand side of the regression, you see that HML has a very strong negative loading on the green factor, and HML's alpha basically disappears. It drops to minus 15 basis points, so it drops by more than 85%, and the t-stat is minus 0.5. And there's nothing about growth included explicitly in this construction of the green factor. So this is an interesting result, I think. On the side, less interesting is momentum's alpha, which has been positive over the past decade, goes away completely when you put the green factor on the right-hand side. I don't know that that's interesting. I think it's just specific to the 2010s because green stocks have just done well period after period. Okay, so now what do we do about expected return? Well, we see that the green factor, its realized return has been positive, but in our theory, its expected return is negative. So how do we reconcile this? What we try to do is not easy, and we only succeed to some extent, but we try to get at the unexpected part of the green factor's return. We try to see what could we use to explain the difference between the realized return and the expected return on the green factor. So we try to identify some key factors that drive the difference, and one of them should be concerns about climate change. We believe that that should be important for the E factor, for the green factor. So we use this very recent Media Climate Change Concerns Index developed by Ardia et al. This index is based on textual analysis of 8 major US newspapers. So what they did was they counted the number of articles that report climate, and they multiplied that count by the severity, by the concern, the average concern of each article, which involves both the negativity of the article and the risk, the extent of risk in that article. So I'm not going to get into the details of this, but it's a very interesting, very clever index in our opinion. So then we take that index, their index, and we calculate a simple sort of a weighted average type of measure, a distributed lag model that captures climate concerns. How much people care about climate? The idea is that if you saw a story in like this month, then you care a lot. If you saw it last month, you still remember it, but not as much. If you saw it 6 months ago, well, you remember it less. It turns out that climate concern measure is plotted here. That's the red line. You see climate concerns have gotten stronger, significantly stronger over the past decade, over the same period that the green factor has done very well. Okay, so we kind of superimpose them on top of each other. It turns out it's not a coincidence. It turns out when you regress one on the other, there is a positive relation. And that's what we do next. So here on the left-hand side, we have the green factor's performance. And on the right-hand side, we have changes in climate concerns, both in the same month and in the previous month, so a 1-month lag. And both of them come in with positive slope estimates, but interestingly enough, only the lagged one is statistically significant. So somehow it looks like stock prices respond to changes in climate concerns as measured by this media index, but with a 1-month lag. Okay, there is some contemporaneous relation, but far from statistically significant. Okay, well, could we, and by the way, this explains about 17% of the returns on the green factor. So a little more than 1/6 of the performance of the green factor is captured simply by this text-based measure of climate concerns. We then look for additional things that we could use to explain the realized returns on the green factor. We take 2 measures of earnings news of companies. We take a change in analyst forecasts of long-term growth. Those are measures of kind of customers' demand for green products. So we trying to get at unexpected profits of green companies versus brown companies. And then we also look at how investors' demands for green securities has shifted over time. And we have a simple proxy, which is flows into sustainable mutual funds. I'm not going to go into the details. It turns out, despite our best efforts, and we have spent a few months, polishing these things, neither of these enter significantly. Okay, they enter with the predicted signs, but it's not a big deal. And you see that in this table here. In fact, you already saw the first column. This is a repetition of a table I showed you a minute ago. On the left-hand side, we have the green factor. On the right-hand side, we have 2 measures of changes in climate concerns. You've seen this. If we add 2 measures of earnings news, you see they enter with positive slopes like you would expect, but they're not significant. If you put in ESG flows, again, it enters with the right sign, but not significant. So it's just not a big deal. Really, the big story is climate concerns. So then what happens when you take the realized return of the green factor, that's the solid line at the top, and you subtract the portion that's due to climate news? You get this portion, you get this dashed line here. Okay, in fact, here we're subtracting climate news as well as that small portion that earnings news can explain. And you see that virtually all of the performance of the green factor has evaporated, has vanished. Now you're looking at a straight line all of a sudden. The dashed line is straight as opposed to upward sloping. And as the confidence intervals indicate, it is significantly below realized performance. So you see that realized returns are significantly above kind of what we would call a proxy for expected return. In addition, if you also subtract the component due to ESG flows, the whole thing tips negative. So the dashed dot line at the bottom subtracts not only climate concern news, earnings news, but also ESG flows. In other words, we're pretending here that there were no inflows, as a fraction of AUM, no inflows into ESG funds. We're pretending there was no climate news, everything was zero. In that case, you actually end up with a slightly negative slope for the ESG factor. What if we, instead of working with green factor returns, what if we work with green factor alphas? So just replace the return on the green factor with a three factor Fama-French alpha. Everything is the same. You see that lagged climate concerns continue being, in fact, even more significant than before, and significance is unchanged. And when you look at the same plots, they're the same as before. So let me remind you, solid line at the top is the realized return of the green factor. The dashed line here is realized return minus the surprise component embedded in climate concerns and cash flow news. We also run panel regressions on individual stock returns. That's like a different way of looking at the same thing. And it turns out to arrive at the same conclusions. Let me tell you what this table does. On the left-hand side is an individual stock return. So we have thousands of firms, individual stock returns on the left, and it's a panel regression with time-fixed effects. So effectively a cross-sectional regression on ESG scores, okay, our ESG scores. And you see when you run that regression, you get a positive and significant coefficient. So indeed, greener firms perform better over this period, confirming the time series evidence I showed you earlier. However, when you add the interaction of these ESG scores with changes in climate concerns, those enter positively, as you would expect based on our earlier evidence. But the coefficient on G now flips negative. Okay, so if it weren't for changes in climate concerns, there would be if anything, a mildly negative relation between ESG scores and returns. So this is, again, another way of seeing that the performance of, the strong performance of green firms seems to have been unexpected. Okay, the last type of exercise I'm gonna show you is we're trying to get at this curious result that stock prices seem to respond to climate shocks with a delay. Remember, I showed you that when this media index goes up unexpectedly, then stock returns on the green factor go up the following month. So we were curious why, So here we look at, instead of looking at monthly data, we look at weekly data, and we find that, and we regress weekly returns on the green factor on this on the climate news index, and you see that there's a positive kind of a positive relation 2, 3, 4, and 5 weeks back, but only 4 weeks back is kind of marginally statistically significant. So it does appear as if markets reacted to climate news as measured by this media index, and we're talking a few weeks here, not a few days. You see that in daily data as well. This is the same regression, but in daily data. So you have daily green factor regressed on the media index. There is a positive relation, as you would expect. So on days with positive climate concerns, you see green firms outperforming brown. So green stocks are a good hedge against climate news. We've known that. But then that's kind of reversed if you look at one or 2 day lags. So really the big story here is that there's a lag of a few weeks in the response. I see I'm just about out of time. So here are the conclusions of our study. We argue that even though green assets have performed really well over the past decade, their realized return exceeds the expected return. And therefore, we do not expect the strong past performance to last going forward. Our theory predicts lower returns on green assets because investors love holding them for various reasons. We construct the green factor, which performed really well, but we link its strong performance to unanticipated increases in climate concerns. We learned something about the underperformance of value stocks here. Value stocks, again, tend to be brown. And we argue that's a big part of why they underperformed in the 2010s. Okay. And that's it. Thank you very much for your attention.
Thank you, Lubos. I appreciate it also being a very new paper, and I wanted to encourage everyone to put in their questions or comments on the chat or on the Q&A box, and I'll direct it to Lubos. Lubos, before we move on to Lauren, one on the empirical, on this new empirical paper, you have made this choice of the last 10 years, given the one, as you said, the kind of the attention of investors is recent, but also the time series may be limited in terms of ESG ratings and so forth. Now I'm always asking the same question, so I apologize if this comes up through that way, but why not global, in the sense that there would be differential attention to climate change in different markets, or also the shift in capital towards ESG may have, started earlier in Europe compared to, say, to the US. I'm not sure, RDS, that work you've highlighted, whether you could measure, immediate climate change concerns internationally, or Gallup polls or other things. That would be an opening question just for you, if you could comment on that.
That's a great question. I totally agree. It'd be nice to look at Europe in particular. That's where they started talking about ESG, or they didn't call it ESG, but social responsibility earlier. And you nailed it. I think what we lack is a very clever media concern index, which we do have from RDI at all. So perhaps it could be done with another way of capturing unexpected returns. The name of the game here is how much of the unexpected return can you on the green factor can you explain? So if you have variables like that for Europe or some other part of the world, then this would be a great paper to write. We are somewhat global here. We look at German bonds and we look at US stocks, but even for German bonds, our evidence is even shorter. So
yeah, I have another question, but I'll defer that to later. So another Pedro on the chat has asked, different Pedro, one can think of investors loading on green factor as a bet on regulation or government eventually acting to. Is this a right interpretation? Is it a sense that there will be a regulatory cost, or how do you think of what is the channel that you have in mind for that?
Yeah, this makes sense. So even in our first paper, we argue that green firms are a better hedge against climate news or climate risk than brown firms, and we actually invoke regulation specifically. The idea is that if something bad happens, imagine we get a bad climate shock, a wildfire another wildfire in Australia or something, and it's all over the headlines. Governments are going to feel compelled to act. So what's going to happen on a day like that is that it's going to be a bad day. So we want to hedge against that. And at the same time, you'll see green stocks doing relatively well in anticipation of favorable regulation. And you'll see brown stocks doing relatively poorly. So our factor being long green and short brown gives you a hedge against these climate shocks. And that includes regulatory shocks. I actually think regulation is a huge part of this. I think that that's probably a leading, I mean, you would know, Pedro, from your work, but that's a leading cause of climate risk here. It's through governments and the resulting regulation that we see a lot of impact. So I agree with this comment very much.
Great. I'll throw in one more question from Rafael, and I'll just rephrase it. It's in the Q&A box. He says, is it possible that the index incorporate bad news about brown firms and good news about green firms? In other words, there's a feedback loop between the stock prices and the news. And, journalists write on, things that happen to stocks on Exxon or whatnot, and that feeds back and reinforces, or is that because you have the design allows for delay right between the news and the asset prices?
I see. That's an interesting comment. I hadn't thought of that. Yeah, what,
another part of the question says if there's an accident in one place, and that could also spill over as well for others. So we can.
let me think about that one. Good question.
Okay,
I don't
all
have a
right.
quick answer.
Thanks,
Thank you.
Rafael. Thank you, Pedro. We'll jump into the second paper with Lauren, and then, as I promised, we'll open up for a broader discussion. And Lubos, there's a third question as well on the chat if you want to address it. So, Lauren, the floor is yours. Thank you.
Fantastic. Thanks so much, Pedro and to Rui for inviting me to come present. And thank you, Lubos, for those really intriguing results and real clarion call on kind of thinking through extrapolation about and around what's happened in the past decade, let's say, in our thinking, beliefs, and preferences around ESG, and thinking how that affects our expected returns looking forward. And so, look, I want to jump into a little bit of a different angle on this, and I'm really looking forward to getting your feedback because this is a project which we dove into from this innovation side of thinking through, and yet is one in which I want to make sure this shows up. Okay, so one in which we have been able to have a chat around the world with different policymakers, practitioners, and asset managers and academics. And so these are all still ongoing conversations, and any comments you give would be super helpful for us in both thinking about it and helping all of these different agents to think about it and how to best approach this. And so, so let's dive right in. And so, look, I don't think I need to motivate this much, right? Pedro, I think, did a great job with even more recent statistics about the explosion in ESG. But I want to kind of bring to light two ways in which this ESG investing has been implemented. Lubos talked about one of them, and that is through these ESG ratings. And look, I'm going to have something to say about these ESG ratings because, look, I have an opinion on them, and I think many of you will have opinions on them that I'd love for you to share as well. And I think they have a big impact in this space. I don't only think that, I know that they do. So our thinking around them is super important that we think about this space. But there's another way these ESG assets, these ESG, I should say, beliefs and preferences have been expressed, and that's through divestiture campaigns. And I want you to keep both of those in your mind. What are these divestiture campaigns? Well, these are where an institution, right, think an endowment, a pension, a university, or a person just says, hey, look, I don't like X. And because I don't like X, I could think about weighting every stock by X and then grading the score. Or I could just say, hey, look, I don't want any X. I'm just completely divesting from X in my portfolio. Okay, and so these also have been adopted actually quite ubiquitously around the world, and they continue to be. Okay, so think about both of those as ways in which these preferences have been and continue to be expressed. Now, I just kind of want to lay the framework for this. So Lubos did a really nice job. I won't spend much time, but there are a lot of good reasons to think that investors might want to express their views this way. The first is a preferences one, which Lubos talked about. And the second, which is also kind of embedded in some of what he chatted about, and that is beliefs, right? Which is that even if I don't have preferences for green investing, if I believe that others do, then we could think that there's a micro-founded reason I might want to invest based on these, what I believe to be others' beliefs, right, or preferences, which is to say, hey, if I think other people really like green, right, that maybe customers will demand products that abide more by some green standard, or that employees, human capital, is going to sort more into firms that take it more seriously, then if I believe that the market hasn't fully impounded that, and Lubos gave us some evidence that perhaps it hadn't over the past decade, right? And we'll see if it does in coming years and decades, but then I might want to invest based on that. And so that's some reasons why I might want to do it. Of course, some reason why I might not want to invest, and this is ESG investing, think about in a delegated portfolio sense, that is that I want some other person to invest for me based on these ESG preferences. Well, look, it's a constrained maximization, right? Because I'm saying, hey, look, I want you to invest for me, but I want you to do it not in an unconstrained way, but constrained by some preference or belief of mine. And I'm willing to do that, but I need to accept either a lower risk-adjusted return, or I need to be willing to pay a higher cost for a given risk-adjusted return because I want those beliefs to be constraints on your investment process. And look, like Lubos mentioned, the results and the evidence on this kind of mixed. You know, the realized performance of these managers, some papers have found that they're slightly better. Some papers have found that they're slightly worse, but they all kind of jump around zero and in terms of outperformance. And part of the reason why that's true is that we just don't have that long of a time series, right? Like Pedro mentioned, that's a really short, the decade-ish of data. And even if you want to stretch it back in Europe, maybe you get another 5 years, maybe another 10. That's a super short time in asset pricing land. And so we just don't have enough time to reliably estimate whether there has been a realized performance, outperformance, or underperformance of ESG-focused asset management in terms of the firm side. So this is often called CSR, right? There's not this corporate social responsibility, also the same evidence, right? Whether it helps firms or hurt firms in terms of their performance, not great evidence, and some evidence pointing in both directions. And so, look, we're not going to look at the space in this lens. What we're going to do is we're going to take the lens of innovation. So innovation is one of the research areas of mine and something that I've looked into, and in particular into patenting. Okay, into patenting, what drives firms to patent, what are the values of patents, what are the threats to the patenting and innovation space. And we're going to look at the universe of green patents. Okay, and why are we going to look at patenting? Well, here's the reason. If it were the case, we're going to focus on E as well, like Lubos. If it were the case, we had all the solutions we needed for E, right? To get to the whatever, Paris Accord, right? The goals of that, or whatever our goals would be on this E side, right? To get a completely clean energy distribution throughout the world or throughout a given country. If we had the technology to do that, it'd be totally cool. We wouldn't need innovation, right? All we would need is a way to distribute that to everyone or to force everyone to engage in that type of technology instead of the existing technologies that are in place. But unfortunately, we don't, okay? We don't have that technology. And so given that we don't have that technology, an important part, a real critical foundation of the solution has to be through innovation. So understanding which firms are innovating the most, which have in the past, and which look like they might have the innovation capital to be in the future, that's a really important part of understanding what the solution will be looking forward, right? Whatever this solution is going to be to get us to that point that we all want to get to, it relies on innovation. So we're going to look at number one, which firms just have produced the most green innovation in the past, and in particular, which firms have produced that green innovation, which seems to be the most impactful. And we're going to kind of jump into what impactful means, but I want you to keep this in mind, right? And the second piece is, hey, look, if we have now some measure and some idea of who's been producing the best innovation in the green space, have capital providers been putting the money toward these producers, right? And the kind of capital markets been getting this right. One big role of capital markets is connecting brains and ideas, right? Putting money where its best use is. And we want to see if that seems to have happened. Okay, and look, here are our findings. We find that a large fraction of green patenting really from the beginning isn't driven by highly rated ESG firms, right? And Lubos mentioned one ESG rating and right how to think through that. It's not driven by those firms, but instead it's driven by firms that are explicitly excluded from much of the ESG funds universe and are the target of many divestiture campaigns that I chatted about. And they are the traditional energy sector, okay? And so a large and growing percentage of all patenting activity in the green space is driven by this traditional energy sector. And moreover, they've really been active since the beginning. Okay, so they were some of the progenitors of green patenting. So go back, think here, back to the 1970s. They were some of the first movers in solar, right? In terms of hydroelectric, in many of these green spaces. So these energy firms, it turns out, allocate significantly more of their innovation efforts, their total innovation dollars, you can think about that, their patents, toward green innovation than any other firms that are patenting in this space. So take two firms, both patenting in the green space, and look at which one is just allocating more of their efforts there. And those turn out to be the traditional energy firms. And these green patents are of significantly higher quality by some markers that exist in this patenting space for high quality. So let me kind of tell you what those are. They're more likely to be cited than any other patents, but the citation distribution is a little wonky, and so it's maybe a little bit harder to interpret on average. Turns out they're also more likely to be blockbuster patents, right? The very, very highest cited patents, and those very, very highest cited patents, the research has found, are more likely to lead to breakthrough technologies. Okay, so, and yet, as we talked about before, these energy firms are explicitly excluded, I should say, from many ESG funds. And not only that, these firms have this weird relationship that I'll show you, that for more ESG-based investing, it seems like that they're doing, and for more green patenting, they are actually punished in some ways where other firms are rewarded. So the exact same behavior, right? If Rui has a firm that's not a traditional energy firm, and yet I am, right? If we produce the same green patent, we're rewarded very differently. So ostensibly the same behavior, we're rewarded differently. And so, look, given this evidence, we thought, okay, that's fine. Maybe they produce more green patents, and maybe they seem like they have higher citations, but what if they're just trying to put points on the board? Right? Like, we weren't convinced. Like, maybe these are these nefarious firms that they're sometimes cast as, and that we think of them as, and maybe they're just patenting to like shelf the patents, right? Maybe they're doing this in a strategic way to try to just put them somewhere where then other people can't access this innovation. And so we dug into some evidence and collected some data to see if they were putting their monies where their mouth is in this situation. And it turns out it looks like they are. Okay, it looks like they are. So in particular, they are investing significant amounts of their capital expenditure dollars on these sustainable investment projects. Okay, so they do many of these projects that are the largest projects in the world. These are joint projects, both with the private and private-public joint projects like this Noordzee Wind that I mentioned here, which is the first wind farm off of the Dutch North Sea to have that large of capacity. And secondly, they were really foundational inventors. So I'm going to show you some patents that really the first solar cell technology patent that came out of Exxon. And so all solar firms today, when they point back to the beginning, they're like, oh yeah, it was that team at Exxon that did this for us. And so I'm going to show you that it's in particular firms outside of energy that are pointing to these energy patents and being like, yeah, those are the ones. Those are the ones that we use and that have been important for what we do. And lastly, look, we look for this and we don't find any evidence that they're restricting others from innovating in their specific product areas. Which is to say, what is a patent? Well, a patent's a legal defensive contract, which is to say that a patent doesn't allow me it doesn't force me to commercialize in this space. All it does is says, hey, look, I can block anyone else from commercializing in this space. So you can think about it as like the physical counterpart. I can let weeds grow here. I don't have to do anything, but I can block for 20 years, usually on average, anyone from innovating anywhere here. And so there are measures here of saying, hey, look, our firm's doing this just to strategically block others from doing it. It's called these patent thickets that firms can create. And we don't find any evidence they're doing it for those strategic reasons. Okay. And so, look, I want you to have those findings in mind. I'm going to spend the rest of the time kind of showing you how we build up to those findings and showing you evidence and really some real world examples along those lines. And in particular, I would love comments, right? Suggestions, ideas on how we tie these results that we have back to these kind of both real world investments and to thinking through what they mean for how we can do this better. Right? How we can do this better, both on the ESG rating side and on the incentive side. I'll tell you already what we hope comes from this project. Now, so number one, just to add something to this conversation that hasn't been there in the past. Okay. And number two, we think there's a better way to do this, right? And so we think that bringing to light this idea that innovation should be part of the conversation might help us to say, hey, look, it's a bit of an odd incentive system where we say, okay, ex ante, we're going to say, okay, you guys can be part of the solution, but you guys can't. So ex ante, we don't care what you have to say. We're going to push you out of here. but you guys can be part of the solution. We think a better way to structure this might be that we reward positive outcomes instead of ex ante excluding some actors from helping us. And in some ways, these findings may not be surprising to many of you at all, right? In the sense that you look at them and say, yeah, no kidding, right? These are profit maximizing firms. And that's true, right? If you look at the way these energy firms have rebranded themselves, BP, right? BP used to be British Petroleum, right? For many decades it was. It's now Beyond Petroleum, right? It rebranded itself because it along with Exxon, Shell, these other firms, which we've spoken to, look, they don't want to be your oil provider for the next 50 years, 100 years. They want to be your energy provider for the next 50 or 100 years. So they have completely aligned incentives to figure out how to provide that energy irrespective of what it is, right? If it's solar, if it's wind, if it's hydroelectric, they don't care. They want to provide that. There's a sensible argument to think that that capital that they've built up in terms of intellectual capital, human capital, might be helpful in thinking through solutions to do that. Okay, and so what we're finding in the paper is evidence of precisely that going on, right? That in some ways market incentives are working here and have worked since the 1970s, right? Since before the word ESG ever existed. ESG, that term came around like 2004. Okay, so this predates ESG. They were thinking about these types of technologies. All right, so we use all patents that are granted in the US, and in particular, all green patents. So how do we define green patents? Well, it would be a really dicey thing for us to do. What's nice is that the OECD does it for us, right? So the OECD, turns out they have this classification system. Think much like if you've used financial data, like a standard industrial classification code. So they say, okay, this is going to be climate mitigation technology. And there's a subclass of that has to do with water, another subclass of that has to do with solar, and so on and so forth. And so we're able to classify and subclassify all these green patents based on their classifications. And so we use that along with Sustainalytics data. Why did we choose Sustainalytics data for our sample? Well, it has both the longest time series and the broadest cross-section for the firms that we're looking at. And so that's why we chose it. We're also collecting, and we've matched to 2 other ESG ratings, and the results look the same with those. Okay, so I'm actually going to start with that patent that I talked about. And this is that patent on that first solar cell technology. And you can see here that this was applied for in 1978 by Exxon, right? And this is really one of the, continues to this day to be one of the most influential patents in terms of citations and being one of those blockbuster patents in that distribution. Okay, if I look at green patenting over time, this is not surprising at all. It looks a lot like Lubos's graph, right? I'm thinking through just these kind of amount of activity going on around these green initiatives. And this, which may be hard to see, so I'll just kind of tell you what's going on here. These are the top 50 green patent producers. And it turns out 7 of these top 50, right, 14%, they are traditional energy firms, right? And traditional energy turns out the second largest producer of green patents, right? Second to manufacturing. And so in this kind of sector classification, manufacturing includes things like autos, right? And so autos are also big producers. And so let me just walk through a couple of these results because we've already spoken about them, and I kind of want to jump to the real effects and then really open it up for Q&A to get your comments. So this is one of these headline results just to give you this first kind of correlation, to give you a summary stat idea of what's going on. So here on the left-hand side, we have the green patent ratio of your industry. So what is that? Well, that is the number of patents in your industry that are green patents over total number of patents. So think about that as the intensity of your entire innovation patent portfolio that's in green. And here, we're just looking at industries that have any green patents at all. So this is a kind of within analysis within green patenting industries. And so while the average green patenting industry has a ratio here, industry green patent ratio of about 8%, the energy sector is about triple that. okay, at about 22%. And we include industry averages for things like leverage, R&D investment, firm age, size, and none of them seem to make all that big of a difference here. Okay, this looks like it's something that comes through and comes through we're going to see a pretty important and unique way. Secondly, this fact turns out to be true even when we look at just climate change, I should say, mitigation technology. So when we just look at climate change mitigation technology, we find the same thing, that these green energy, the traditional energy firms, they're producing about 3 times as many of those patents as well. Okay, and so this in some ways is one of the more surprising results to us anyway. And then we're going to decouple this. And that is to say, if I were just to correlate, that first column is just really, you can think about it as a correlation between environmental score and green patenting. And that correlation is negative and significantly negative, which is to say that the more green patenting that goes on, the lower the environmental score, right? Or higher environmental score firms have less green patents. But what we're going to show you in the next 2 tables is that that's completely driven by the energy sector. So when I look at firms outside the energy sector, the opposite holds true. It's completely the opposite, that these firms, the more green patents they have, the higher their ESG score. It's just these energy firms that get penalized in a very different way. Okay, one other thing that I want to highlight here, which all the results, I'm not going to go through them all, but all the results of the paper, we do for all of the other top green patenting sectors, which is to say, we didn't want this to be driven by something like, oh, well, maybe you have to, there's some certain scale you need to do this, or maybe it's something special about any sector that's doing a lot of green patenting. It turns out it's not. Okay, this is something very unique to the energy sector in terms of its disposition with this green patenting. Okay, and so this result, again, these numbers are a little tricky to see, so I'm just going to kind of tell you what these next 2 tables say. They essentially empirically establish what I just said, that green patenting is an awesome thing to do in terms of ESG scores, unless you're in the traditional energy industry, right? So for firms outside the energy industry, there it's great, and you get rewarded for every incremental green patent you get. The opposite is true for these traditional energy firms. Okay, and turning to citations, this is what we talked about before, that these energy sector firms, they have patents that are just more highly cited. So if you were to think, and we kind of thought at the beginning, yeah, maybe again, they're just patenting to patent to get numbers out there, but they're like crappy patents. It turns out by this measure anyway, and we'll get to other measures, they're not. If anything, that they're higher quality patents measured by citations. And in particular, I'll show you in a slide or 2, these are not self-citations. It's not like the energy firm just citing its own patents over and over again to inflate citations. They have significantly more citations, particularly from firms outside the traditional energy industry. Okay, not only do they have more citations, but they have more of these blockbuster patents. And then again, the blockbuster patents takes care of this the skewed citation distribution and some issues you might have, and one should have, about thinking through just citations. And these are these patents that are most often associated with the real blockbuster and transformational technologies that come with industries. Turns out energy sector produces more of that type of innovation as well. Okay, and the last thing before I turn to the real effects, and kind of Lubos hinted at this a little bit, and it'll be a surprise to none of you. Capital has not gone in this direction toward innovation, which is to say that these energy firms and the firms that produce the most green patents, which are these traditional energy firms and the highest quality, they have had capital that's retrenched from them, right? Capital's been pulled away from them in this mutual fund universe. Okay, and you can measure that in terms of the percent holdings, in terms of their weight relative to their index weight, the amount of these that just have 0 holdings by funds, that all kind of goes in that same direction. Okay, so look, the last thing that I want to quickly touch upon is this real investment piece. Okay, and so I just want to show you a couple measures of that real investment they're doing to see if they're putting their money where their mouths are, right? Or again, they're just patenting to block others from coming in and are just trying to really cordon off this space for as long as possible so that they can get rents from this traditional energy. And so we collected data on the actual investment of these firms to see what's going on. And it turns out that it doesn't look like they're blocking other firms from getting in. So this is a measure of these patent thickets. And it turns out that traditional energy firms don't have these patent thickets, right? They're not creating this like weird thickening mess and making it hard to innovate in this space. Like I mentioned before, that the citations of traditional energy firms, the citations from their patents actually come more from outside the energy sector than other green patenting firms come from outside their sector, right? About half of the green patent outside the traditional energy firms will come from outside their sector, whereas 3/4 of traditional energy firms come from outside their sector. And lastly, they invest more, and they invest more per patent in actual projects. So they're putting up more CapEx, right? More money toward these ideas, toward these patents than the average firm outside of their industry. And again, you might say, hey, look, it's not a surprise given that they have higher quality patents, so they're putting more money behind them. And we kind of agree, and yet it's interesting to see that they're doing this, right? Putting the actual money behind it instead of just, again, taking these patents and shelving them, which is one plausible hypothesis, even given the patenting numbers that I showed. Okay, and so that's where we are, right? That's what we've come up with. Just to kind of summarize, and then I really am looking forward to your comments and suggestions and pushing this ahead. Look, we find consistent and robust markers that both the quantity and, importantly, the quality of green patenting is higher for these traditional energy firms. Yet these are the firms that capital is often restricted to in terms of both these ESG ratings and these divestiture campaigns. And so our analysis suggests that there's this perhaps surprisingly negative relationship between the generators of innovation that help us confront E. And again, we need that, right? We need innovation because we don't have the solutions yet, right? The solutions are going to be something that we come up with. And so loading on innovation in this space is critical to coming up to the solution that we all want to get to. Okay, we believe that trying to understand this better and the role of ESG ratings in this is really important because, of course, this is super hard to do, right? We don't want all investors to have to try to understand which firms have the highest E, not to mention S and G. And so it's great that we have intermediation here in terms of ESG raters, right? The fact that they're coming in and being like, no, we got your back. We'll tell you which has the highest E, the highest S, the highest G, and you can invest based on that, right? The fact that they're not taking this innovation into account and they have a whole host of other issues that Pedro kind of hinted at, right? That's a real problem. And moreover, our findings raise important questions as to these exclusions and the way we think through innovation more broadly may need to be rethought, right? And this idea that instead rewarding positive outcomes, rewarding anyone who can help us think through solutions, engaging, in other words, with the traditional energy industry, as opposed to just excluding them, might lead us to better and kind of quicker outcomes, right? It might get us to that point we all want to get to more quickly. And so that if this is a picture, I want to end with this picture of that team from Exxon from 1978. And that's that first solar cell they came up with. Okay. And we are collecting data. So some of the data that Lubos talked about on the green to bond data, thinking through textual analysis and looking at real activity. But again, I'm looking forward to hearing your comments and suggestions for where else we should look and what else we should be looking for. All right, with that, thank you very much. And I'll open it up to Q&A.
Thank you, Lauren. And so I will take the prerogative of the first question, and Rui has a question, so I'll ask him to unmute and maybe open up to others as well. And I would encourage, if you're shy, to put the questions through the chat box, and we'll also put those out. But so to get started, Lauren, fascinating papers, both papers, of course. And I'm not an innovation expert or patent expert as you are. But I was wondering, with this time chart that you have on the green patents, that it does take off, but then it sort of flattens out after 2011. So I'm kind of interested. And also the if you were to go back to the 1970s, you could say, well, how many patents were done on brown, right, at the time, on oil rigging or oil technologies and so forth, versus like greens? And Brazil, in this respect, there's one question in the chat, which is Brazil was doing biofuel rather than, and that did not take off in many other places like the US. There was no equal subsidies towards that in the US. So the question is like what is your general feel that there's enough patents out there that's possibly addressing? And also, final part of that question is, by counting patents, we're still not counting dollars. So the last part of your work showed like the capex that's going out. But so can we scale how much capex, how many dollars, and if it maybe not capex, but other forms of investment are going to R&D dollars or other forms of to green versus brown back in the day versus now, by energy versus others? Sorry,
Yeah.
long question.
No. There's a lot of sorts there. That's like a triple, quadruple sorting, but let me try to do it.
I'm sorry.
No, not at all. So look, and all great questions. And so let me kind of start, but then how about hit back up whatever I missed along the way? And so, look, these are great points, right? And what is certainly true is this: if you were to go back 40, 50 years, a larger percentage of the patenting going on at these traditional energy firms was, of course, having to do with, we'll call it brown technology, right? And yet still a larger percentage of patenting of all firms was, right? No other firm was doing green patenting. So they were some of the first to do it, right? They were the first movers because they saw this as an issue before the rest of the world, right? And so one of these, the things that we were worried about, honestly, and that others have brought up is, hey, look, maybe they're just doing this because we held their feet to the fire, right? Because we've got around ESG and because we got these ratings, because we're like, hey, we want you to innovate now. That's why they've started to do all this patenting. Well, that's demonstrably false. And a nice thing empirically is that we have evidence that before ESG even existed, right, before the term even existed, they were already thinking ahead. And that thinking and that patenting, by definition, right, by temporal definition, could not have been driven by ESG. And so we see some patenting going on then, some patenting going on now. But to your very pointed question, no, we don't have the patents we need. We do not have the technology we need to solve this problem. And I would say we don't have this technology we need on both the green side, and these are harder to interpret, but the like de-browning side, right? And so what about something like carbon capture? Carbon capture are some of these other patents around brown technologies and how to divest more slowly from them, or natural gas, or like Lubos mentioned, nuclear, or trying to like slowly get out of these. Super important for how cleanly we can exit these browner technologies. And so in that sense, de-browning is greening, right? So a negative slope on brown is green. And so we may call them brown patents, but those are green patents. And so in thinking through those, we also need more of those and more innovation along those lines. And anyone who's sensible and who's sensibly thought through this space would never make a comment like, oh, we should just completely get rid of traditional energy, right? Even by the most bullish estimates, are that it's going to take us decades for us to slowly unwind all of the technology that we have in place and assets in place in order for us to move to green technology. So that's a lot of pollution that can happen in decades. And that's especially true within developing markets, right? That have many more of these assets and technology and less ability to transition, right? Less capital transition. And so in that sense, all of those technologies are going to be super important for how greenly we can get to green, even if they're not green in particular. And your point about Brazil, I think, is a really important one. I'll give you an anecdote for a student that I had from Haiti. And he was like, oh, in Haiti, actually, we have hydroelectric. It's all about hydroelectric because we actually have so much moving water that is what we are focused on. And so we are using our superpower in terms of natural resource to develop the technology that fits us the best. And that makes a lot of sense, right? You want to use whatever resource you have available. So I don't think there will be one technology, right? Where solar is plentiful, they'll use that. Where the sun is plentiful, let's say around the equator, they'll use that. But there's a really silly thing to do, unless we can store energy much better, as you move away from the equator. In other places, they'll use wind. In other places, it'll be hydroelectric. And so I think parallel processing and parallel, I should say, patenting along all these lines is the way to go. And so I guess in Brazil, you're mentioning it's more of these biofuels. I think that's fantastic, right? But that the fact that it is there and that you have market segmentation here, I think is a wonderful part of the innovation. And I think will and should continue.
Right. Do you want to go for your question? It is related a little bit to Lauren's last point.
Lubos, you want to ask your question first? I guess we had related questions. Yeah? So then I'll try to ask you both questions at the same time. So
mine is actually building on yours, Rui. I was just wondering why these energy firms are engaging in so much patenting activity. Is it out of necessity? Which way does the causality run? Like, should we, in other words, should we favor them, or should we just expect them to do this? Because if they didn't, then they would, they would die more quickly. Or, I mean, how do you think about this, Lauren? I love the paper, by the way.
Yes, thanks very much. And so I think, look, it's hard to separate, right? We have what they've done. We have what they say they're going to do. And so if, look, here's what we can observe. And so they are doing these like weirdly unprecedented things where they are making very public signals about what they're going to do. So it could be that these firms just say, hey, look, we're going to do our best, right? We're going to do our best to try to innovate here. But they are saying, this may be hard to see, but they are publicly stating that they are going to hit the Paris Accord target, right? We are going to be net zero. They have done this. This is Shell, but BP has done this and all of these firms. And BP actually reached out to us. So we spoke to their head of ESG and their head of climate mitigation technology and climate change mitigation. And they are claiming to us, so I'll tell you what they claim, and then I'll tell you kind of my interpretation. They are saying that, look, we are important partners in this. And we're important partners because we understand energy distribution so well. We've been doing this for decades. We know what the world needs. We know what the world needs and how that changes over the business cycle, over different parts of development, for rural areas, for urban areas, as different countries, when there's a war, when there's not a war. And so they claim to have this knowledge, which you just can't pass on, right? And this human capital. And so that's why they're in that we'll just call that the amassed capital they have is a natural complement to any innovations that could happen. And that allows them to innovate better. And so this fact that their innovations really do look better, is it because they have all that? I don't know. Or is it because they've had better selection, right? They can attract better scientists or whatever because of this. I'm not sure. And so it's tricky, right? And to your point, are they doing this just to survive? Well, in some ways, I guess it doesn't matter. As long as they have steep enough incentives, it's not that I guess we wouldn't care as a world if they can get us the patenting they need, that we really need. Now, if your point is, hey, look, they're going to produce these really strategic patents that look like they're what we need, but they're not really what we need, so they're not producing it, and so they're pushing us back like decades and decades, that would be a really nefarious thing. We don't get any markers that that's true. And I guess the best evidence we have that that's not true is that every firm outside of the industry, right? This is not them deciding, hey, this is not them saying, hey, our patents are really awesome. We look at all the firms outside of the energy industry and they're saying, yeah, those are the awesome patents. We really like these. And so it seems like the world is agreeing that these are pretty important in terms of building on the shoulders of innovation. And that's very much like it is, like academia, right? We build on past work. And yet capital markets seem a bit late to the party in terms of that, as do these ESG raters, like you mentioned. They just don't seem to be taking into account that rich and available information.
Okay. So I'll follow up on this topic here. So I guess the impression that I had, like at least, maybe I'd like some clarification. So is the effect, the energy effect that you're finding of the negative relation coming from it's coming basically from a effect across firms within a sector? Yeah. So is it possible that actually this is happening, this catch-up effect, that people that have are low on E, yeah, on the SG side, they trying to invest more within the same sector, and then you have a sector effect which is positive. Yeah. So you have greener sectors are get high E's and brown sectors get low E's. But within the sector, you have the negative relation. So people are playing catch up within the sector. Is it happening there? Because you're focusing a lot on the energy side here. So, and then I'll have a related question to Lubos somehow, because I would like to understand the sector effects as well. What is driving the results there, whether it's intra-sector actually, the effects.
Yes.
Well. Yeah.
Yeah, and so look, another great question. Actually, I screenshotted Lubos's slide. I think I'm gonna take his slide where it shows perfectly how high Exxon was within sector. And then yet when you did this sector weighting on it, then it got to this rating. And look, which one is right or wrong? You know, it's not clear, I think, right? And it depends on, like, do you want to structurally have those built into your E scores, right? Do I want to structurally say, yeah, these industries have to be low? Or do I want to say, hey, look, within the industry, yeah, no kidding that, you know, Exxon is going to have more carbon produced than Google. And so I'm not going to hold that against it, right? These are just structural differences among industries, and it's silly for us to think of that on the E, S, or G side, right? Maybe there are structural things built in we do or don't want them there. And so I think that's a great way to think about it, Rui, and Lubos, how you separated those was great. We do some within industry analysis. So you're right. Most of what we do is we're calling every firm within E a one in some sense, right? From a numerical standpoint. And your point is that they're not a one, right? Like you want to think within the energy sector, that variation in E. So we haven't done much on that. We should do a little bit more to see how that's going on, specifically kind of within sector. And so is E trying to decipher between them? And is that taking into account innovation? So from what Lubos is seeing, what we see too, is that there is variation within sector on E. There is, right? So some of these other scorers that aren't MSCI, they don't have as much variation as perhaps as MSCI does. So Sustainalytics doesn't have as much, and some of these others, but there is. And the question is that lining up with innovators getting a higher E or lower E? And are they responding along those lines? And Rui, to your point, what might be nice to see is, again, pre-ESG, because we have patenting going back to the 1970s. So we have, before ESG ratings and before these incentives ever existed on ESG ratings, by definition, we can see what's going on with these firms back then and within the traditional energy space. Yeah, these are great questions, great suggestions. Thank you, guys.
Could I take Rui's question very quickly? A great question about industry adjustment. I actually have an answer for you. Let me share my screen for 5 seconds. So the solid line is the ESG factor that I showed you, which is not industry adjusted, and the dashed line is one that is industry adjusted. So suppose you go long green, short brown within each industry, and then you aggregate across industries. You see that there's still outperformance, but it's not nearly as strong as across industry. So I'd say it's more an across industry phenomenon than a within industry phenomenon, but there are bits of both.
A quick question on your paper as well. Great paper, both actually. So what's happening with value spreads, for example? Did you look at price evaluation ratios or anything like that to see that maybe the spreads are widening faster on the green dimension compared to the sector dimensions and so on, or
no? Good question. The only thing we did with value was what I showed you. So we regressed value on the green factor, we regressed the green factor on value. We did not look at the differences in book to market ratios between, you know, one leg and the other. Could be done. Yeah, good suggestion.
Interesting. And like your control for earning forecast, you're looking at like a 1 year or long-term ones, because the long-term ones tend to extrapolate a bit more the past growth and other things. So you're focusing there on the short-term or more long-term forecast?
For earnings news, we have two measures. One is long-term, so long-term earnings growth, and the other was just earnings announcements, kind of a 3-day window around earnings announcements. I didn't get into it much because it wasn't significant.
Oh, great.
Alain, do you want to ask your question as well?
Yes. So
please.
I will ask my question. Lauren, great paper, fantastic presentation. Also, my question is the following: as you have all capex measured or figures could you measure the marginal costs of the green technology, and is it decreasing or increasing over time? Because if you want to have what they say, a green revolution, we need to have decreasing cost of investing in green technology. Could you measure that? Some ideas of, okay, is the cost of investing is decreasing over time, or we reach a point where it's too expensive to become greener?
Yeah, this is a great question, right? And so you can think about this. And so I think your question is important, and important at a micro and macro level, right? Like we can think about this from an industry level. I can think about this as economy level, a country level, like Pedro mentioned before, or a firm level, right? Like, am I moving down my own cost curve, right? And so, and then, look, I think it's an important question. We haven't looked into it. We can try to think about it. And in particular, I think what our data might help us to look into and get some insight to is into investment on the green innovation side, right? Because you can think about different types of investment. I can invest in human capital. I can invest in idea capital like this, in physical capital, and all these are going to be important for coming to the solution, right? And in particular, it's that interplay, right? Or that interaction between physical capital, we think, and idea capital here, that are going to have to be part of the solution, right? I'm going to have to understand new ways to build things, and then actually go out and try to build them and make mistakes, and then try to move down my cost curve there. And so we can try to look into that and think about ways we might be able to estimate it. Thank you. It's a great suggestion.
Rui, how much time do you want us to go overboard? The Portuguese are known to go forever.
I'm concerned about Lubos here. Like,
exactly.
Very late for him, and I guess if anyone has more questions, I guess we can always follow up later.
Yes, yeah, please do email us, Lubos and I, if there are any more questions or comments.
So I'd like to close and also put a shout out for tomorrow's panel with Laura Starks from UT Austin and Aaron Nguyen from Northwestern. And it will be another dimension of the ESG debate. We'll have one about the investors and another about the social dimension with the employees and the management, some scores there, etc. So particularly very thankful to Laura and Lubos. Thank you so much that, to pull this off in such short notice, that we are all able to be here, 3 different continents in 2 parts of the, two continents, but 2 parts of the North and South continent. And Lubos, thanks for joining us from Europe. Really appreciate it. Rui, any last words, or Alan?
No, I guess we'd like to thank you very much for being here, and I hope that we can do this again, but in Brazil, and having caipirinhas afterwards, I guess would be a lot nicer. Hopefully you can do that next time. Yes. Thanks a lot.
Thank you so much, gentlemen.
Yeah, my pleasure. Thanks so much.
Thank you. Bye-bye.
Bye-bye.
Bye.